Are you ready?
Ready.
All right, let's go. Kevin here, top 1 financial advisor and best-selling author. We are here to talk about the stock market. If you have been following financial news over the weekend, you saw a spectacular fallout from the crypto space, particularly in FTX. So in today's video, I need to explain quickly what happened with FTX, but also how do you protect your stocks? How do you protect your ETFs and the money that you have in the market? There's actually a protection that you might not know about that can protect you up to $500,000, and I'm going to show you a way that you can protect even more. All right, so let's go ahead and get into it. I'm going to give you a quick overview of what happened with FTX. Basically, a guy known as SBF, Sam Bankman-Fried, I guess, or Freed, however it is you want to pronounce his name. He founded FTX as well as some research firms. He was once worth $26 billion. He is now worth next to nothing because he basically, I can't really call it a Ponzi scheme per se, but he built FTX. It didn't have as much money as what it thought it did. Somebody said they were going to buy it, and they backed out, and they sold their stake, and everything just started to fall apart. And basically, users of FTX saw all this stuff happen and said, look, let me pull my money from this app. And enough people, or this exchange, rather, enough people started to pull out that FTX said, look, y'all can't pull y'all money out no more. We're going to lock this thing down. We're going to go into bankruptcy, and y'all may or may not get your money back. The app was then hacked for, I think, $600 million. Now, people are speculating whether or not it was him that pulled the $600 million out. People are speculating whether or not he has fled the country and is now somewhere in South America. There are a lot of rumors flying around about what happened. The fact is, people who are investing with FTX do not have their money, and it is locked, and they may not get that money back. Other facts, Tom Brady invested close to $600 million in FTX. The Miami Heat's arena was named after FTX. That was ripped off. Things have been falling apart. And new investors say, look, I see what's happening in crypto, and that's not great. What about the app that I have my stocks on? What about my ETF? What about my index funds? What do I need to do? Do I need to just pull my money now? Like, what's happening here? Well, the truth is you are protected. Okay, you are protected by SIPC. That's the Securities Investor Protection Corporation. It's very similar to the FDIC. For those who are banking in the U.S., FDIC protects your cash at your bank. And exactly what happened during the Great Depression, this is why we have these protections today. Because basically in a bank, your regular checkings and savings, you're protected up to $250,000. So if your bank just goes bankrupt and just disappears off the face of the earth, the federal government steps in and says, look, you have up to $250,000 in protection. We're going to make sure you get that exact amount of money and no more under that particular rule. And that's it. So you're protected. Okay, as long as I don't have more than $250,000 at one particular bank, I'm good. Okay, SIPC is the exact same thing, or similar thing rather, except for your brokerage accounts. And what this protection does is protect you up to $500,000. That's $500,000, and in that they're protecting up to $250,000 in cash from that amount, and the rest in securities. When we say securities, we basically mean stocks, bonds, mutual funds, and ETFs. Now there are a few others that fall in that category, but those are the primary investments that we are discussing. What does that mean? They do not protect against losses. Okay, so if you had, let's say, I don't know, $10,000 and the value of your stocks went from $10,000 to $9,000, they're not protecting you for that. They don't care. Okay, what they are doing though is, let's say you have 100 shares of Walmart. Walmart announced earnings today on Tuesday when we're doing this video and podcast. But let's say you've got 100 shares in Walmart and the value is $10,000 and it drops down to $9,000. Well, you still have 100 shares, and SIPC is saying, look, that's under the $500,000 cap. Your app closes and crashes, goes bankrupt, and whatever happens, we're going to make sure you get your 100 shares back. What happens to the value is totally up to you and what you invested in. But that's essentially what they do. Now, also, remember that when you are investing in any app, you may have cash that is invested in things, and you can have some cash just left over that you didn't invest. Well, that cash is left over, they're going to give you up to $250,000. Okay, so $250,000 in cash is the max, and then the rest is in security. So $500,000 total is what you are protected against. And you can rearrange those numbers however you want. You can say $400,000 in stocks and $100,000 in cash. You can say $250,000 in cash and the rest in stocks. You can say $500,000 in all stocks. Whatever combination, that's how you can have your money protected. Almost every single app, especially in the US, for stocks, bonds, ETFs, so on and so forth, is going to have SIPC protection. I guarantee you, go to your brokerage app right now, or the website anyway, you can scroll down, it's going to say SIPC there, okay? If you look at the emails that you get from any of these brokers, the confirmation, scroll to the bottom of the email, and it's like unsubscribe and all that kind of stuff, you're going to see the SIPC protection there. You are protected. Now, your next question might be, well, what if I have more than $500,000? Number one, congratulations. Number two, there are different ways that you can protect yourself here too. And again, I don't think enough people know this. This is through titling rules and having different brokerage apps, which is one advantage of doing this. For example, and this works for your bank as well. I am one individual. I can have $500,000. My wife can have $500,000. As a family, that's $1 million. We can also have a joint account, and that one can have $500,000 as well. Total, that's $1.5 million. And then I can go to another brokerage and do the same three things again, and that's $3 million total, all under SIPC protection, assuming that we have the $1.5 million anyway. So number one, that's why we're here, right? I want you to have $500,000 at minimum. Okay, that's what I want you to do, is why we cover some of the best stocks to invest in inside the members only, and show you trading techniques and all that kind of stuff. So yeah, I want you to have that, and you can get there. Okay, we can definitely get there slowly and over time, not overnight. I'm not here to sell you snake oil. Okay, it's going to take you time to do that, but it is definitely possible. But in either case, seriously here, the thing is, you are protected for those securities, stocks, bonds, ETFs, mutual funds, index funds, all that type of stuff. You are not protected for crypto at this point in time. And that's one of the benefits and drawbacks that we've talked about with crypto, because it was decentralized. It was not regulated. Now you're seeing some of those risks of things not being regulated because you don't have any protection. You lose your crypto, the crypto app closes up and leaves and is a scam or what have you. That's it. I had a little bit of money on Celsius. That money's gone. I may not ever see that money again. Now, I'm not stressed because, just like I tell y'all, that 5% rule, I made sure that I stopped at 3%. Okay, I said 3% of my money is going to be on Celsius. If it works, it works. It didn't work, that's fine. It's 3%, I'm fine, right? I'm going to let it go, okay? Now, if I didn't adhere to that rule, I said, hey, let me take half of my net worth and put it in this thing because I think it is safe. I think it's stable coins. Yeah, right? It ain't work out, right? Same thing with FTX. It's not the only crypto app that has done this, and it might not be the last. And one of the issues here is that a lot of these companies are privately held, and we can't necessarily verify all the time that they have the right balance of assets and liabilities. And this is what is assumed to have happened at FTX, where they had, for example here, $40 billion of debt and liabilities and just $10 billion of cash and assets. So imagine that, right? You owe $40 billion. That could be, assets that they loaned out, could be just regular loans or money that they owe you, the investor, and they only had $10 billion. So when that $40 billion is called, when these customers come back to hand and you pull my money out, what do you think the app is going to do? They're going to cut everything off and say, look, everybody stop. I'm going to hold on to this money so I can figure this out and go through bankruptcy and play this out through court. That is what is happening with FTX as well as Celsius. So that's an issue. There is somewhat of a loophole here, not for getting your money back in those two spaces. But if I'm investing in crypto, what I would encourage you to consider, keyword consider, is look for companies that are publicly traded. So right now, that may be Block, that could be Coinbase, and maybe that's even PayPal, because both PayPal and Block do have ways that you can buy crypto through Venmo and Cash App. Now, the advantage here is that if you are ever curious about how healthy PayPal is as a company or how healthy Coinbase is as a company, guess what you can do? You can go and check earnings. And you can go and see how healthy that company is and say, look, I don't trust you because you have this much debt and not enough to cover it, right? And make a determination on your own. Whereas I didn't get an opportunity to do that with FTX. I didn't get an opportunity to do this for BlockFi or Crypto.com or Celsius. I'm not saying other than Celsius and FTX. I'm not saying those others are financially insolvent or struggling or not. I don't know, because they are not required to give me their statements. And we can't really evaluate them from a financial perspective. We don't know, and that is one of the risks. However, public companies have to disclose that information. Now, even though they have to disclose it, doesn't mean that if something were to happen to the crypto side, that they have to protect any of that. They don't, because again, crypto is not regulated by SIPC. However, let's say that Block or PayPal, and let's focus on Block because Block owns Cash App. Cash App, you can buy stocks there. That is protected by SIPC. And if something were to happen to Block, the 4 shares of Coca-Cola that I own, I'm still going to get back. Okay, so I'm still protected by SIPC. For the stocks and the cash there, I may not be protected for the crypto part of it. However, I can trust Block, even though I'm not investing in it. I'm not investing in it at all, but I can trust Block financially because I can audit them. I can see what they have. I can look at financial ratios. I can do all that stuff to make sure that, hey, y'all not broke, right? I can understand that at least I know y'all got some cash and y'all not going to go bankrupt tomorrow. Whereas we can't necessarily do that for a lot of these other privately held companies. And that's not just crypto, this is across the board. The advantage here is just that, you know, if I got my money in it and it's something that's deregulated and decentralized and doesn't really have a whole bunch of safety nets here, I want to make sure that my money is in a much safer place. Now, unfortunately, we all had to see this and learn this the hard way as opposed to what we assumed was the case. Because, I mean, think about it. If I see Tom Brady investing in something, if I see the name on an arena, you have an air of confidence that, hey, they've got to be pretty solid. I mean, the guy who founded it was worth $26 billion. It comes with an air of trustworthiness. That wasn't the case. That was not the case. And this is a part of the learning curve for crypto. Now, is crypto bad? I wouldn't say that, but it is risky. It is risky. I've been telling you about this risk for years now, and it's why I say you do what you want to do. But I say limit it to 5% of your overall holdings so that if something goes down, it's not the worst thing in the world. I had mine at about 3, close to 4%. Hey, I'm all right. Right? I've got a little bit of Bitcoin still. I haven't sold it. It's still there. But I'm more so focused on stocks like Cigna and GPC and others because those are working, right? And those are also protected through SIPC up to $500,000. All right, so that's it. That is how SIPC works. You are going to be okay provided that your brokerage is under SIPC and provided you're investing in a trustworthy crypto place, which, you know, those are hard to come by nowadays, and we'll see what happens in the next few days and weeks. Now, last thing we'll talk about is our members only. This week, I'm going to walk you through a very successful trade that played out quite well over last week. And also, if you're looking for places to invest that pay dividends and that you can audit and look into yourself, you want to make sure you check out the members only as well. Cover 10 stocks that pay dividends that have grown quite well in 2022. All of them are above 30% gains in the last 6 months at minimum. Okay, at minimum. So you want to make sure you check that out. I also showed you a way on how you can make money when the market is down as well. Even though, yes, the market has been up the last few days, you want to make sure that you can play both sides of the game. Okay, so you want to make sure you check out the members only. That link is right here. It is also under this video. And that's it. I'll talk to y'all later. Make sure you hit the like and subscribe button too. Okay, we're almost to 5,000 subscribers. Okay, all right, that's it for me. Talk to you later.